Everybody, welcome to this episode of the Note Closer Show. As always, Scott Carson, excited to be here with you today. Today's topic, I wanted to share an asset class in the note space that we're starting to see a lot more of coming across our desk, across our books. We're seeing these opportunities coming in from different lenders out there. Now, what am I talking about? Well, I'm talking about reverse mortgages. Now, if you don't know what a reverse mortgage is, let me take a minute here to explain what a reverse mortgage is. Kind of like an annuity instead of a traditional loan. Now, what happens, a reverse mortgage is more for an elderly, older borrower, somebody who's at least 62 and above. If they've got co-borrowers, both borrowers would be 62 and above. It's a loan product that's not FICO based. It's based exclusively off the equity and the value of the property. So what happens is if somebody's lived in a house for a while, they usually got a bunch of equity, right? They have a smaller mortgage compared to what the actual value of the property is because it's appreciated time. So what'll happen is a company like Financial Freedom Network, which is a reverse mortgage lender out there, one of the biggest ones, they'll come in and they'll evaluate the borrower, him and her spouse, look at their kind of, morbidity tables, what's the average person be, and they're going to take the equity of the asset and then either A, give the borrowers a lump sum. There's a lump payout where they don't have to pay their mortgage. All they do is pay taxes, but they don't have to pay a mortgage up till the point that one of them dies. Or B, they give them a lump sum or refinance out their underlying mortgage and then pay them a monthly stipend. Monthly payment goes out to them, not with them having to make a payment in. Now, like I said, it's great because it can often save our elderly folks from losing the homes in a foreclosure process. They're trying to stay in the house if there's enough equity there. And like I said, it's not FICO based. They don't care if you've been late on your mortgage or anything like that, or you're late on your DTI. It's all really relative based on the product. But the great thing, now the one stipulation, and this is where we're seeing these deals. We're not buying reverse mortgages where people have just done it, like Financial Freedom Network and stuff like that. They're not sending out us to take over these reverse mortgages while the borrower is still alive. What we get is we get lists of these loans where the borrower has passed away. And when a borrower passes away, the family, the estate has the option. They have the first right of refusal to come in, pay off the payment or the mortgage amount or whatever it was that was financed. They have the first right to do that, to pay off that house. And sometimes you have people that have a reverse mortgage. They may not have a will, so it's tied up in probate for a year or two or a period of time, depending on which state it's in. Or they may not have any heirs at all. Or they have heirs. We've seen this where the heirs are fighting. They can't make a decision. One person wants to go this way. The other people want to go that way. So we get these lists in from some different funds recently. And it's not a note play. You're not going to get a dead borrower back to the table. You're not going to have them rise from the dead, the day of the body snatcher. You're not going to have zombies showing up. Oh, we want to pay your mortgage. Okay. They're not showing up. How do we pay off the mortgage? I want to eat your brain, okay? You're not having it happen. What you have happening is basically, for us as investors, real estate investors, it's a note play. We're technically buying a note, but the only play on this is not to modify, not to reinstate. Now, you do have the option. You could modify the terms of the loan or redo the loans if you want. If the borrowers, I'm sorry, not the borrowers, because borrowers are deceased, but the estate, the heirs, daughters, family, if they wanted to stay in the house, yes, of course, you could modify that loan. You could tweak the loan, give them a new loan, and turn it into a new loan, new origination. You had to re-originate the new loan for the family. Or you could set up and just keep the name of the person estate and have them making payments like subject to existing terms. But most of the time when we're getting stuff, it's because the borrowers don't want to play ball. They can't play ball. There's too much work needed. They don't have the money to fix it or pay it off. So it becomes an asset that we buy with the sole purpose of foreclosing. Now, you can work a deed in lieu in some cases if the estate is willing to work with it. We've had it where the estate, 2 out of the 3 were willing to sign, and the third one wasn't. Or I've bought notes where the borrowers were, deceased. Move on. There's a couple of things you need to keep an eye out for. A lot of times these reverse mortgages are going to be Fannie Mae loans, FHA loans, and you have to have a FHA servicing company involved with that. Who does that mean? That means it's like SN Servicing, somebody who has to handle it. Not all mortgage servicing companies are going to service a reverse mortgage. I found that not that hard way. Others will, especially if it's a fast foreclosure state like Texas. Here, we bought some stuff in Texas and we could foreclose in 30 days. It wasn't that big a deal. Other states, it's a longer process, so you got to be careful who the servicing company is on that. And the great thing is when you're doing due diligence on these, there is servicing companies. You ask to speak to the attorneys. Hey, what's the process? Can I retain you as counsel? Some of these attorneys don't want to deal with one-off deals. Once they've gone through this process and the note's been sold, they have it in their books just to pass the note off to somebody else in a lot of cases. All right. But they can be pretty decent deals. I mean, you have to always put eyes on these assets because oftentimes these properties have sat vacant for a while because nobody's lived in them or somebody has passed away and died in the property. Okay. Or they went to hospice. We like, I'll give you an example. We bought one a few months ago where the borrower had moved out of the property here in Texas and moved back with his family in New York and died in New York. And he had this property laying on here. And the borrower didn't really have much of a will. And well, he had a will, but the borrower's family, the sons and daughters, couldn't get together, couldn't figure it out. So we just went through the foreclosure process because of the fast foreclosure state. So here's the big stipulation of them. I don't usually buy notes to take the property back. These, if it's in, you know, I bought a few in different states because they're faster foreclosure states, or I already have other assets in those states, or I have teams in those states I've worked in the past that can go in and get me interior, viewage. And that's a big thing, especially some of the funds. If they've already winterized the property or they've securitized the property, changing the locks, putting a lockbox, stuff like that, turning the water off, or, putting whatever in, you always want to try to get interior access because some of these can be in great shape where it just needs a little TLC, paint, carpet, and maybe some updating. Or you can have like what we saw this weekend. We went up to Waco and looked at an asset that looked pretty good from the Zillow view. The inspection report was okay. But when we walked it, it was not the same asset as the inspection. I mean, it was the same property, but you get what I'm saying. Is the condition had deteriorated dramatically. I almost fell through a floor. It was two homes shoved together, basically, it seemed like, and one was like 3 feet taller with on a pier and beam foundation. The other one was on a solid foundation. And it was in a rough part of town. That's not saying they're all in rough parts of town, but you have to keep in mind. We had another student of ours who drove by one in Corsicana, Texas, big house, like 2,900 square foot house, but somebody hadn't lived in it in a couple of years. When he walked through it, he's like, it looked like somebody went through and grabbed the valuables and dumped out things on the ground. It wasn't a squatter or a homeless person living to, but you got to be careful. Make sure that stuff hasn't happened. I've seen it where the copper's been ripped out and all the plumbing's gone, the AC and the heater's gone, and you're left with basically a shell and a full rehab. I don't really want to do those. You want, especially in today's market where everything's at, you want to be doing light rehabs. And when it comes to pricing on these, if it's in a faster foreclosure state, I would go maybe up to 60%, 65 if it's in pristine condition. But if it needs work, I'm usually, hey, values this, I'm going to be at 50 cents on the dollar for the most part. Okay. Like one, we saw borrower value was 230, borrower owed like 205. I ended up picking it up for 109. I'm into it, rehab and everything, right around 130 is what the final numbers are going to be on that thing. So it's a good win. It's just that we wanted to get it sold as soon as possible, and that will vary on a market by market basis. Other ones, I got to wait 60 days to finish the foreclosure. Got lucky that the judgment was filed. The servicing company first told me, first the guy I bought it for, the company I bought it from said, hey, yeah, legal has just barely been started on this. Well, I find out after the fact that we closed. I knew I was expecting a 6-month foreclosure. Judgment was already filed. It's a 60-day foreclosure. I got interior access. The house is in good shape. It's a little outdated. Got some red shag carpet in the front, but that's okay. Not a big deal. But the exterior of the house is good. The roof is good. It's got good curb appeal. I don't do anything there. I just got to update a couple things and, got some of that wooden paneling on the inside that is famous for older homes, but it still looks good. And it's consistent with that neighborhood that's in. It should be a pretty good rental to somebody. And that's the thing you got to look at, especially if you're going to take assets back these days. You have to be prepared. If you don't sell them in a timely fashion, it might make more sense to, I'm going to use a 4-letter word, to rent the property out for a period of time if the market drops. That's what you run into right now if you're buying new notes in longer foreclosure markets, is that foreclosure time frame. If market values are dropping, you may be stuck holding an asset for a while, and that's okay. Pivot. Sometimes we got to call an audible Just like in football, you got to call an audible. Maybe it's not a great time to sell the asset. Maybe you need to look to get traditional financing or bring in a private investor to finance this deal for 12 months. Maybe it makes sense to hold it and ride it out and wait for the wave to come back and make some cash flow, or at least break even on a cash flow play and grow the stats, and then take your profits temporarily, maybe in cost segregation or depreciation off your tax return, because that's a profit margin a lot of folks forget about, especially if you own the actual asset. That's the thing about reverse mortgages. It's not to own the note. It's literally, it becomes a real estate play. All right. Now, where do you see a lot of reverse mortgage? Well, you see them in Texas. You do see them in Florida. You see them in India. You see them in the older Rust Belt parts of the state, of the country, and stuff like that. You'll see them everywhere. But make sure you make sense. And one of the most important due diligence processes, talk to the attorney, talk to legal. How far are you along in the foreclosure process? How, if we continue this, can you give me some estimated dates? So they tell you 60 days, plan on being 90 days. If they tell you 90 days, plan on being 120 days to finish the foreclosure process. But that's one part of your due diligence you've got to add to the numbers is, okay, I need to speak to an attorney and I need to get real numbers and stuff. Look, if you get it cheap enough, great. If you're happy doing a full rehab, and it's in an area that you like, you're fine. That's completely up to you. I just don't want to be doing heavy rehabs right now if markets are dropping in some cases. Yes, you're buying at 50 now, that's great, but maybe you're at 60 in a month or 70 cents on the dollar in 6 months when the market changes next year. Who knows? If you're hanging on to it, it can be a win or a lose, but I think honestly that we're into this, it's going to be a 12 to 24 month process as the market corrects yourself. And if you can buy a property that you can hold on rent and make cash flow and stuff like that, that's one of the important things to look at. That's got to be your plan B if you can't sell it traditionally and sell it off. I wouldn't be looking to do Airbnbs. I've got plenty of friends that have Airbnbs are getting kicked in the teeth right now as people are tightening up on their money stuff and not taking trips like that. But look at it. We still need great properties for rentals. We still need great affordable real estate for a lot of individuals out there. And here's an opportunity for you to pick up technically at almost REO at below REO pricing in a lot of cases out there for you. And you, by being a note investor, you have an opportunity to really see these deals well before they ever hit the MLS. And maybe you sell them at the auction. Maybe you price it to sell at the auction, which is one of the things that we've done, is look at what's going on in the market, price it to sell. When you're giving bidding instructions to the foreclosure attorney or your crier in a non-judicial state, hey, they're always going to start at zero, but you as the note holder, you have the right to tell them how you want it to sell and what the bid. So if they owe more than the property's worth, it doesn't make sense. If you don't want to take the property back, don't make your maximum bid or the beginning bid be the full payoff. Maybe you do it at 70 cents a dollar, see if there's any takers, and work your way up from there. Because you, as the note holder on this, technically the lender, you have the right to tell the attorney where you want it to go. Hey, if you get a bid above 75 number, 75,000, take it. Give it to somebody else. Let somebody else do all the heavy rehabs. And that's the thing too. You don't want to be doing rehabs until you actually own the property. It's okay to go in and winterize it, secure it. Maybe you need to board some windows up to keep stuff from breaking. Change the locks. Maybe you need to put some dogs, these big metal doors on stuff. We've done that before in different parts of the country. But honestly, I would be buying these in just either non-judicial states or judicial states where the foreclosure time frame is less than a year, or that they've already done most of the foreclosure. You're not going to see that a lot of times on a spreadsheet. You got to inquire when you're looking at due diligence and pricing and go. And here's another thing: do yourself a favor. If you see an asset that pops and you can go by and take a look at it, take photos, take a walkthrough video, do that. Even if it's trashed out, send that back to the lender, send that back to the seller. It will build you goodwill with them so that when you make another offering or you're looking at other stuff, it can then make sense for you. They may give you a better deal because they realize that, oh, you know your numbers, you've helped us out in the past, we'll give you a little bit of help on this. And I've had that happen where an asset manager sent me an asset in Indianapolis, and the street view on Google showed one thing, but when we actually had somebody go out, the property had been demolished by the city. And that's one thing I keep in mind. Some of these properties may have code enforcement liens or nuisance liens because nobody's been taking their property in some time. Maybe the grass is overgrown or there's broken windows, stuff like that. And the code enforcement and zoning enforcement may start tacking on bills. That doesn't mean it's a no-go. Call and find out if there are any zoning complaints and say, hey, we're taking this over. Can we get some of these fines reduced dramatically? We've had $1 million lien reduced down to $2,000 from the code enforcement. $50,000 lien reduced to $1,000 because we were stepping in and rejuvenating the property and helping to keep the property in the neighborhood up. So reverse mortgages, not a bad investment if you're okay taking the asset back and either selling at the auction as an REO or taking it back and fixing it up and selling it on the MLS if you do end up taking it back. So check them out. If you're a fix and flipper, all right, you're a rehabber, this can be a great strategy for you to find some deals that nobody else has seen. Because the competition is you literally step in front of the line 6 to 12 months. It's an opportunity for you. It's also an opportunity for you guys, investors out there that are buying notes, and you have a meetup group somewhere locally that they don't mind doing that in a faster foreclosure. This could be a possibility for you to put something under contract and wholesale it to a end buyer who doesn't mind hanging around for 60 days to finish the foreclosure and then sell it off, and then rehab it, sell it off, and go from there. It's an opportunity for you to make some money either as an REO sale. If you're looking for rentals, this could be a potential way for you to do it as well. Fix and flipping, or ultimately, if you need to make some quick cash or something like this might be a great way for you to wholesale some assets out there. So reverse mortgages, it's a different asset class. Doesn't mean it's bad. You just need to know the rules to play by when it comes to evaluating them and understanding your exit strategy. The exit strategy with the reverse mortgage is not to get the borrower back on track, because the borrower's dead. They're worm meat. They're 6 feet below ground. They know hither. They've gone off to the eternal rest. Now you got to be careful. One thing you got to run into is if somebody's passed away in the house, you may want to go and cleanse that thing. We had a student of ours look at one, and he caught a ghost on camera. True story. Caught a shadow person on camera, and you never know what you'll see in some of these properties. Just be careful. Make sure if you're ever going in a house and you've got the lockbox code, make sure you treat that properly with respect. Take some photos. Take a video. Announce yourself. Hey, investor, real estate knocking on the door. I've had that happen before, where somebody was drugged out of their mind, or you had squatters. You be careful with the vacant property. Also, be very wary of the neighborhood you're in. We went by a property this weekend that I wouldn't let Stephanie walk around during the day, let alone at night, because it was a rougher neighborhood. It's just a rougher neighborhood, mixture of homes and mobile homes. Some of the mobile homes were really trashed out. Some were burnt down. It was a rougher area than what it looked at online. So be careful, mind your surroundings, especially this time of year, ladies and gentlemen. There's a lot, especially if you're listing a property, trying to sell a property, stuff like that. I've had friends that have been accosted, robbed, sexually assaulted, showing houses, especially after dark. So if you're a woman out there, take precaution, take somebody with you, take mace. Hey, we're Texas, go packing, but always have somebody with you. It's not saying that you're bad and can't handle it, but it's just a guideline. There are a lot of desperate people out there that are doing stupid things, and just protect yourself. Always be prepared is the way I look at it. And that way, when you're prepared for the worst never happens. But if you're not prepared, the worst can often happen if you're not prepared. So go out, take some action, everybody. If you have any questions, feel free to reach out to me at talkwithscottcarson.com. That's talkwithscottcarson.com. That'll take you directly to my schedule. I'm glad to talk with you. Get a scenario, deal you're working through. Hey, feel free to reach out. And like I said, glad to talk. Go out, take some action, buddy, and we'll see you all at the top.